Please welcome the panel on Private Markets Reimagined, moderated by Yup S. Kim, Chief Investment Officer, Texas Municipal Retirement System.
All right, good morning and welcome to Private Markets Reimagined. I'm joined here today by the titans in private markets who've spent a good chunk of their career really helping shape global private markets into the behemoth and the powerhouse it is today. So panelists, I woke up this morning, and as I do every morning, I opened up ChatGPT and asked it a very important question. What will private markets look like in 100 years? And this is what ChatGPT had to say. Number one, private assets will be widely tokenized, enabling broader participation, real-time secondary markets, and more seamless portfolio rebalancing, even for traditionally illiquid strategies. Number two, GPs and LPs alike will use AI to analyze deals, assess risk, and optimize portfolios. And lastly, capital will increasingly concentrate around secular themes like energy resilience, AI infrastructure, healthcare innovation, through specialized compounding platforms built to endure beyond traditional fund structures. And so today, really excited to have this conversation around what private markets looks like in the next 50 years. Today, global private markets represents about 8 to 10% of global equity market capital. Forecasts say in 50 years, that number could be up to 25 to 35%. So the implications of that, the quality of that growth, is absolutely critical for investors, for companies, for consumers, for enterprises, and for society. And so we'll kick off with a slightly unconventional way. And so, Bennett, maybe starting with you, just a very quick introduction, and what's one thing about you that most people don't know?
Okay, I am the executive chairman of Hunter Point Capital. We're a firm that makes different kinds of capital solutions to GPs. We buy minority equity stakes, we lend them money. And the one thing that not many of you here know about me is I actually like to go to bed early, like 9 o'clock.
Jacob.
I'm Jacob Kotzebue, co-president at Platinum Equity, based here in Los Angeles, a private equity firm with about 40 billion AUM and a deep operational bench with a focus on corporate divestitures, among other transaction types. I've been at the firm about 23 years. And one thing not many people know about me is I grew up in my father's bookstore, living in an illegal dwelling unit in his bookstore, and my playground was his bookshelves.
Wow. That's the secret to success. Miranda?
Miranda, I work for Shamal Holding, heads up their private market investments. We invest the firm's capital to global private markets across private equity, private credit, and infrastructure through funds and co-investments. So one thing most people don't know about me, and I actually didn't know until in my early 20s, I have one extra teeth than most people. So in my early 20s, I went to see the dentist, and dentist like, do you know you have 5 wisdom tooth? So I was like, okay. So I always joke, my teeth stole all the wisdom in my head.
So I'm Donna Milrod. I'm the Chief Product Officer at State Street. I also am responsible for our private markets business as well as our digital asset business. So I'm sure we'll talk about tokenization. Yeah. I'm not a titan in the industry. I've only been at State Street for about 6 years, but a long history in the financial services business. What most people don't know, and State Street obviously is a pretty big bank. We're a globally systemically important bank, and we have a pretty large asset manager, as well as a very large asset servicing business. And in the private market space, we service probably around $2 trillion in assets under administration, and State Street overall sees about, we estimate around 12% of the world's investable assets flow through our infrastructure. So we have some pretty good insights on what's going on in the world. I guess nobody really knows a lot about me. So I just would, one fun fact for someone who grew up in financial services, I'm actually a proud owner of a Nevada gaming license.
Oh.
So that's something that people kind of find interesting.
Nice.
So there you go.
Jan Robart, managing partner at Dawson. Dawson is a firm focused on providing structured liquidity solutions for both LPs and GPs. We're about 22 billion of assets under management, 225 people in Toronto, London, and New York. And I think for whoever has gotten to know me over the years, they'll be interested in knowing that I'm an introvert. That's the reaction I was expecting. A social introvert, but I am definitely an introvert. It takes energy being around people versus getting energy from that.
Got it. Awesome. All right, and the second question, you need to answer it within 5 seconds. So second question is, if you're not a private markets titan, in another life, what would you have been? Yan.
Bush pilot in the Arctic.
Ooh,
Professional photographer.
nice.
I'll be a medical professional.
Oh,
AI LLM researcher. There's backstory, but we don't have a lot of time.
yeah.
I would have been an architect.
Awesome, awesome. All right, so with that, why don't we dive right in? So Bennett, you are considered in the industry as a leader of leaders. You know, both existing and next generation investors really look up to you for sage advice on how they can really cultivate their platforms and firms. You've built one of the greatest global private credit platforms, and the GSO sale to Blackstone was a landmark move, transformative for the industry, with many that followed afterwards. Yet most M&A deals in asset management don't succeed. So just share with the audience, why do some M&A succeed and why do others fail?
Well, I certainly agree, most fail. So let me focus on what made the GSO sale of Blackstone work. There were 2 or 3 things. One, there was a compelling strategic rationale for Blackstone and for GSO to make this transaction happen. Blackstone had just gone public. They had a gigantic private equity business, a gigantic real estate business, a gigantic fund of funds business. They were nowhere in credit. And they felt it was a hole in the portfolio, and they had to buy somebody to help them scale. From a GSO perspective, the strategic rationale was we thought they'd make us much better investors. We were a domestic U.S. firm, and when I say domestic, I mean like east of the Mississippi domestic.
Sure.
And to be able to tap into the intellectual library of information flowing through the halls of Blackstone, it was just impossible not to be smarter. It was impossible not to have access to more companies. Importantly, it enabled us to be global. Secondly, culture is, I think, the most critical aspect of these kinds of combinations in a consolidation. The person running Blackstone at the time was a fellow named Tony James. He was the president and CEO and effectively ran the company day to day. He was my boss, my mentor, and very good friend, much of my adult life. And any good idea I had at GSO, I kind of copied from him, really. So the investment process was the same across both firms. The compensation process was the same. How we recruited and developed talent, all the same. So it was just an easy fit. And then finally, it's all about alignment. First and foremost, we felt this was better for our LPs. They would make us smarter. We would develop better themes to create more conviction around how we invest. We translate all that into better performance. And secondly, the alignment, we didn't cash out at all. In fact, it was 100% about growth, and we rolled everything into the business. And I think those are the 3 critical elements.
Absolutely, thank you. Jacob, as co-president of Platinum Equity, you've really seen the evolution of the private equity playbook in the past 2 decades. A question for you, this is the first year where kind of private equity AUM is actually slightly down, and this is also a time when, for the first time in my career, I'm seeing PE firms struggle to raise their next fund. And there was a time when the great inefficiencies and immaturities in the sourcing, selecting, value adding, and exit motions where in each of those categories you could add tremendous alpha to your overall portfolio returns. But today, skeptics would argue that each of those pieces are now all commoditized. What is the future of kind of alpha creation within the private equity playbook? And please share with the audience kind of your views on that.
Sure, thanks. Look, I think the skeptics are onto something in that the basic skill set has equalized across a large swath of private equity. But those who are creative enough and capable enough can still innovate within private equity. And there's lots of ways to do that. From Platinum's perspective, a few of them are talent at the GP level. I think a lot of private equity focuses on hiring for high IQ. And that's a big portion of their success. And I think that is a necessary component, but not a sufficient component. We believe at Platinum that you have to hire for high IQ and high EQ. How you make people feel impacts what you can learn in due diligence and impacts how you can inspire people once you own a company and impact the business. Secondly, we believe that we can be differentiated by continuing to invest heavily in a deep and broad operations team. We have nearly 100 people, full-time employees at Platinum on the operations side of our business. And then lastly, within the value add playbook itself, continuing to evolve and innovate. So when I started at the firm 23 years ago, we were firmly in Ops 1.0, which was all about cost extraction, and became world-class at that. As we looked at what we were able to methodically and repeatedly underwrite and transform in businesses we owned, we realized we could move up the P&L into impacting gross margin and impacting revenue trajectory, combining that with balance sheet expertise, being able to right-size balance sheets, then getting into digital transformation and making that very systematic and repeatable, then human talent evaluation and enhancement as a systematic part of our process, and now having hired additional people into the firm on the operations side around how do you implement AI in ways that increase productivity. And because we invest in a lot of old world economy, manufacturing, distribution, we're also very focused on robotic automation and think that that kind of innovation and playbook lets you continue to generate alpha even as kind of the basic skill set has commoditized.
Absolutely, and your comment on EQ resonates strongly. You know, there's a quote, good investors sell features, great investors sell outcomes, and exceptional investors sell feelings. so I think that is a true competitive differentiator. Donna, let's talk about product innovation. ChatGPT seems to think that there comes a day when illiquid assets trades as liquid as Amazon stock through tokenization and real-time secondary markets. How far are we from that reality? And what are the major obstacles towards that reality?
Yeah, so first of all, I'd say that we're already kind of taking steps towards getting private markets in a place where they can trade more frequently. So even without tokenization. So all the advent of the semi-liquid products that you see out there, BDCs, I'm sure you'll talk a little bit about secondary trading. So I think we should recognize that and acknowledge that. And tokenization also as just kind of a mechanism, as a way to create fractional share classes, et cetera, is already here and being used for private market interests. But I'd say that the barriers for adoption are the same barriers that we have today with all the challenges with the extreme growth. As an asset servicer, we see this every day. I mean, inherent in private markets, funds are very bespoke processes. A lot of unstructured data. I mean, GP, LP agreements, loan agreements, all of that is just all paper-based. So that has nothing to do with tokenization. Tokenization doesn't help any of that. The AI tooling you talked about is really what's going to be key, and it's already kind of being deployed. So it's a big barrier in terms of getting to a place where we can have more liquid, trading type activity. And then I'd say, just for a moment, we should maybe pause and think, is this really right for an Amazon-like stock trading moment for private markets? I mean, there's inherently benefits to having a long-term investment cycle where you're not pressured for quarterly results and daily valuations.
Yep.
And we're about to experience that with the current economy. So let's not forget that actually has a benefit to be able to have that long-term perspective and be able to be invested over the cycle and not have a whole lot of pressure for daily valuations, for example.
No, absolutely. So yeah, and 10 years ago, you and I were sitting in a very mediocre Tier 2 Midtown diner.
My bad.
And you were with two of your partners, and you had a dream to really build an innovative private markets organization. And here we are 10 years later, 22 billion, 230 plus people, and congratulations on
Thanks, my friend.
incredible success on building Dawson Partners. I guess, fast forward 10 years from today, is private markets still outperforming public markets? Or is there kind of an equilibrium reached through capital flows where investors like myself are indifferent from the returns I can generate in public markets versus privates?
First of all, thank you for not dumping me after the diner situation, but I appreciate that. Look, I mean, I think from my perspective, before we can look forward, I think you got to look back. And what I find really interesting, we actually just did a white paper on the last 25 years of performance in private equity. And what we found is that private equity consistently and persistently outperforms public markets. We went back to January 1st, 2000. If you put $1 into private equity, if you put $1 into the Russell 3000, you would have gotten 6.6 times your money with the Russell 3000, not bad. 19.9 times with private equity. That is the opportunity cost of not investing in private markets is significant wealth. Now, some skeptics said, yeah, that was a moment in time, great, but what about the long to medium term? And so we looked at 5, 10, 15, 20, 25-year results, and consistently, persistently, they have outperformed in all of those. So yeah, there might be some 1 to 3 year kind of volatility with the public markets where there's a period of outperformance, but over the long term, it's very clear to us that private markets outperform private equity. And then people are like, yeah, but it depends on when you get into private equity because you got to time it. And actually, we looked at the last 100 quarters, 97 quarters out of the 100 quarters, you would have outperformed investing in private equity over public markets. And in those 3 quarters where you didn't, the next quarter you would have superseded. So it's very obvious, it's very clear that for us, private equity outperforms public markets. Then the question is why? And you asked Jacob that question. We looked at those three sources of alpha. And what we found is, does private equity buy well, build well, and sell well? Let's go through each one of them. Do they buy well? Our data suggests that private equity over the last 25 years has bought at 9.5 times, where public markets at the same period of time was at 12.5 times. So they bought well. Did they build well? We looked at 224 companies before they went private, and then when were they sold? So by the time the private equity held, margins went from 20% to 24%. So they built well. And then we looked at, do they sell well? Well, now that you've built a better business, can you sell well? Can you get a better multiple? The answer on those same 224 companies is yes. You would have bought it 9.5 times, you would have sold 10.5 times. So that's the story of private equity. I can go a layer deeper, which is the volatility in private equity. Everybody says, oh, wait a second, there's more leverage in it, so inherently it needs to be more volatile. Actually, when you look at private equity versus public markets, over the last 10 years, the worst you would have done in the volatility of private equity would have been about 9% between the best and the worst 10 years. For public markets, it would have been 20%. So you're doing less than half the amount of volatility and better returns. That's risk-adjusted returns. So we're big believers in private equity. The question then becomes, can this get sustained? And the answer for us is, like, I don't know how many times over the past 25 years I've heard that, oh, private equity is done. You know, this is it, this is the moment, they had a good run, and now let's move the chapter. And it's all about innovation in this market. But I think for me, for us, what's really special about the private markets is the governance model. If you ask me, it's public markets that are broken. It's not private equity. If you look at it between the two, you look at public market, 70% of public markets right now is computer traded. Nobody's mending the shop. And when they do look at the fundamentals, then they look at quarterly earnings. How do you build a better business focusing on quarterly earnings? You can't. If you look at private markets, and by the way, that shareholder base is highly diversified. There's nobody really giving kind of guidance or to the management team. It's all different perspectives. And you look at private markets, it's a concentrated shareholder base that's aligned, that's focused on the long term. So they're focused on the next 3 to 5 years. That's how you build a better business. And in doing so, you can generate better returns. So we are and continue to be big believers in private markets. There is a reason why private markets have gone from 5 trillion to 15 trillion, right? Capital is flowing to private markets for a reason. There is a reason why there's half as many public companies as there are, and now private markets is growing. You know, management teams want to be private, not public. So we believe in the continuation of this, and we can talk about what secondary role is. So the issue with private markets is liquidity, and I think Ben and I on this stage are providers of liquidity solutions to this market. That's what it needs.
All right,
Yeah, may I ask you a question?
Oh, no, you may not.
You're becoming a moderator.
As an allocator of capital to private equity,
Oh, no.
what premium to the public markets do you think is appropriate given the lack of liquidity, given the higher leverage?
You know, I think, oh my God, I don't like no, it's all good. I think it's a very difficult question, but I think over the long term, outperforming the public markets by a healthy 300 to 500 basis points is reasonable. If you look at the historic returns of private equity, the median returns in private equity has come down. There was a time when it was high teens. Now it's probably closer to low teens. But the top quartile managers somehow don't follow that trend, and they're able to kind of build their sourcing, selecting, value-adding exit capabilities to retain very healthily above 20% net. And what that tells you is that as an LP, your mistakes are more costly. You know, I mean, in a zero interest rate environment, tier C managers, tier B managers, tier A managers all produce tier A returns. And so in a more difficult, challenging environment going forward, I think you will see tier A managers only generating the tier A returns. Okay. Now over to Murad. The last point I did want to make is the United States has 30,000 companies that generate over $100 million of revenue, and 90% of them are private. And just the opportunity for truly identifying inefficiencies, to really growing local champions to national champions to regional champions to global champions is there, right? And so I think I'm still obviously a believer, and yeah, that was a very good pitch on behalf of the industry.
Look, I mean, is it perfect, this industry?
Yeah.
No. Do people make mistakes along the way? Absolutely. Is there change and innovation that sometimes causes friction? Yes, but overall, on average, over the medium to long term, it's outperformed.
Yep.
And I don't see a reason why it can't continue to do that.
Sure.
I think you have a captive audience that totally believes in the private equity, investment thesis. So I think you sold everybody.
Okay. Thank you. I
You're
appreciate that.
preaching to the converted, I guess.
Miranda, you sit in a very important allocator seat in the Middle East. There was a simpler time in private markets when you had a fund, a GP commit, maybe some co-investments, but the life and job of an LP was fairly simple. But today, we're seeing a wave of private markets innovation, and I would argue how LPs spend time today versus 10 years ago is a bit different. And so what excites you about the current wave of private market innovations, and what concerns you?
So generally, I'm very excited by many innovations in private market landscape. I'll highlight three. However, all those innovations has to be used thoughtfully. So I highlight three here. Number one would be the innovation around providing a holistic solution to portfolio companies, to GPs, to corporations. I think that's what private equity is about. It's about partnership. It's always about win-win game to all the market participants. So for example, hybrid capital solution to companies to fill the next phase of growth, or GP solutions to increase their alignment, increase their capital investments in their funds. Those are all very positive. However, my concerns around this one would be, what if these are misused, using NAV loans improperly to inflate the DPI, IRRs, use of GP continuation vehicle, not because you love the assets, you see further upside, but just because simply you cannot sell in the markets. I think if things go wrong there, it's really damage the reputation of this industry. And second is about innovation of how to get capital deployed more efficiently. So first of all, take a step back about Middle East LP base. So maybe GCC LP base. So slightly different probably from the United States. There has been, because of economic growth, there has been fresh capital or new institution formed in the GCC to come into the private markets. The capital is patient, is long-term, is looking for long-term partnership. The question is always, how do we get the capital deployed more efficiently? It's not probably the most efficient way, just waiting for capital to be called. So partially, it's solved by participating with trusted GPs on co-investments. However, that's not all the solutions. So we are excited about innovation around, having a portfolio of seeded high conviction portfolio company that you can invest in day one. Perhaps evergreen vehicle if structured correctly. The concern is always about the alignment of interest. Is the kind of like the assets conviction is there? Is the valuation done correctly? Is GP continue to be aligned on the performance of those assets rather than just gathering more AUMs? That's the second. The third innovation, I would say, is about increasing access to broader investor base, whether it's broaden like more high net worth individuals or retail platforms. I think those are good capital which may fuel the growth of private company as we see private companies are staying private for longer. Could be a solution. The question for institutional LPs would be around how are we impacted? Is the return expectations should be adjusted downwards because the lower cost of capital mechanism?
Sure. No, thank you, Miranda. Very good points. Bennett, some argue that private markets are becoming the new, more complex public markets. So concentrated capital, lower transparency, and increasing systemic and leveraged exposure. You have portfolio company leverage on skeptical EBITDA, and you have sublines, you have leveraged management companies at times. And so just curious, are we just recreating the same risks with better AGMs and better catering?
I don't believe so. I think systemic risk, what does that mean? From a regulatory point of view, the regulators of the banking and insurance industries worry about the contagion.
Yep.
If there's a large concentrated position on someone's balance sheet, they lose access to short-term funding, what happens? Particularly if you have retail investors and retirees looking to annuities and things of that nature. And I don't believe the private markets represent that. If you take Blackstone, the largest private market investor in the world, they are not a SIFI, a significantly important financial institution, despite the fact they're the biggest in the world. And that is because they operate out of hundreds, if not thousands, of different funds. None of them are cross-collateralized. And if there is a bad performing fund that incurs a lot of losses, the investor base, these big, sophisticated sovereign wealth funds, pension plans, insurance companies, can absorb the loss. So the regulators have pushed that risk, I think, very astutely into those institutions who have the proper capital structure with the right institutional LP base who could absorb the losses. So I do not believe that it represents systemic risk to the financial system. Doesn't mean there won't be losses, you know, people won't be disappointed, but I think it's pretty well thought out.
Yeah. Thank you.
Okay, can I add a little?
Yeah,
sorry.
of course.
So what I think is interesting is that, let's go to the secondary market for a second, because we talk about, so with private markets, liquidity is always the question. But going back to that governance model that we were talking about earlier on, you've got GPs that need long-term patient capital. They need 3 to 5 years to do what they need to do with their businesses. You've got LPs that have, you know, built their portfolios in different times, in different ways, reacting to the market in different ways. And so you've got these two conflicting kind of agendas, and in the middle is this secondary market that actually bridges between the two. It allows for these two ecosystems to operate and provides that liquidity in the middle. I think what is going to happen over time is that the secondary market is going to become the public market of private equity, if that makes sense, enabling the injection of liquidity, but allowing these two ecosystems to survive so that you still can maintain, you know, those concentrated shareholder base, the alignment that private equity brings to investing.
Yeah, I don't disagree. All right, Jacob, as co-president of Platinum Equity, you see a tremendous amount of PE deal flow. If you had to give a letter grade to the quality of your deal flow today, what would you give it? And how do you think about private equity's ability to maintain its historically high returns amid high rates and slowing distributions?
Okay, so from a pipeline point of view, I'd break it into 2 letter grades.
Sure.
Quantum versus quality, and compared to what we expected, say, at the end of last year. Quantum is down. I think that's actually to be expected when you have big market moves in terms of speed and magnitude. There's a lot of kind of pause and people take a breath and readjust. So quantum, I'd give us a B, but not unexpected. Quality, I'd give us an A+, because what we are working on is right down the middle of the fairway of what we like. It's situationally available alpha based on the situation, and operationally available alpha based on what we do to businesses. So that's from a pipeline point of view. And I think the quantum thing will resolve itself. We've been through a lot of cycles, and people adjust, and it gets back to normal. I think your comment about interest rates being high, I think we should put it in context. Been at this for 23 years in private equity. I think interest rates actually are really low from any longer term historical context. And I've invested at a much higher interest rate environment than we have today, and have done very well in that environment. So I don't think high interest rates are going to impact the ability to generate good returns. You just have to buy right relative to the interest rate environment you're in. DPI is an interesting dynamic because I think a lot of LPs have made commitments counting on a historical level of DPI, annual DPI returns. And that has been under pressure for the last 5 years, and in particular, the last couple of years. I don't think it's too strong a phrase to say there's an industry DPI crisis. And back in 380 BC, Plato's Republic was written, and in it, he coined the phrase, necessity is the mother of invention. And that is what is creating some of these really interesting vehicles now, whether it's continuation vehicles or NAV loans or the secondary market, to substitute for those LPs who need DPI because they've made commitments and they don't want to be over allocated to private markets versus public markets. So I think if it's not misused, it can be great alignment among the ecosystem to utilize these vehicles. And I would expect that until the regular sale market is functioning properly again, you know, these vehicles are going to continue to grow and will serve, even when they are functioning normally, exit markets, will still serve as alternative tools.
No, it's a great question, and it's a reminder that the delta between a median investor and a top 5 percentile investor in private equity can be 15 to 1,800 basis points. And so ultimately, it is a micro business. You know, here we're talking a lot about, you know, kind of industry medians and averages and things of this sort. But, you know, you live and die by kind of the 12 to 24 decisions you make over a period of time. And so I think that's it's an important reminder of that for sure. So Donna, there's been endless talk about the democratization of private markets and the need to expand the TAM from a well-penetrated, the $150 trillion of institutional capital is well-penetrated, but there's another $150 trillion in private wealth, high net worth, ultra high net worth markets. But it turns out that an institution's liquidity needs and wants are vastly different from that of an individual. Mm-hmm. And so I'm just kind of curious, what's working in the democratization of private markets and what's not working?
Yeah, so I think it's, you'd be hard pressed to argue that given the returns that Jan laid out, that retail-like investors shouldn't have access to that exposure, right? So I think just on the surface, if not abused, we have to move in that direction. It's on, especially when you think, I spent a lot of time on the mutual fund side in the public markets, and we just celebrated the 100-year anniversary of the first open-ended mutual fund in the U.S. And just think about the wealth creation that happened there. For to fund people's retirements. I mean, you would know this better than most, right? But at the end of the day, there is this weird misalignment, if you think about it, with mutual funds and the inherent investment horizon of a retirement,
Yep.
So again, another reason why retail investors should really have access to this asset class. So. But look, institutional investors can understand liquidity aspects. They're obviously more sophisticated. They understand the tolerance for longer hold periods, et cetera. High net worth family offices act like institutional investors all the time. You could argue, have the same understanding and kind of investor education, if you will. When you move into mass affluent, and then the defined contribution 401k space, and then ultimately retail, I think the advisor community is not well educated about this alignment of, investment horizon, et cetera. Sure. So there's a lot to be done there. So I just it's important we talk about democratization, but what are we actually talking about? Sure. So I think that's important from just understanding that. In terms of what's working, I think product innovation, I think you heard that already.
Sure.
In the panel, we've these semi-liquid products that gives opportunity for the investor to see liquidity in other intervals other than 3, 5, 7 years. Yep. Is good, and there's even more product innovation coming. SSGA, State Street Global Advisors, has just kind of put private market exposure in ETFs. So there's a lot of wrappers that are looking a little different, that are bringing that exposure in. So I think that's working well. Product innovation. I'd say also technology, digitization, given what I talked about earlier. Yep. Is starting to rapidly accelerate, not only within the firms themselves who administrate this stuff, distribute, but also, fintechs are, there's like new ones all the time kind of popping up, dealing with some of the, bespoke processes I talked about before, especially given how much Excel is really prevalent in this space. And I think advances in AI also help. What's not working is, kind of the flip side of all of that. So the notion of daily valuation and what is inherently not able to be valued that frequently is, fundamental problem. If you think that's a problem and you think you need to get to democratization. And I said it before, but like advisor education, investor education, I think regulators are slow on this. As well, the regulatory, investor protection from a regulatory perspective. So I think there's a lot that needs to get done. I think people are addressing it very, very quickly. But I think suitability, everybody throws that word out. But again, we need to make sure that advisors and investors are educated, that they can have the opportunity to be exposed to this, great asset class with potential great returns, better than the public markets, but they have to be patient. They have to understand that fundamental illiquidity and not pretend for it to be something it's really not.
Yeah, no, absolutely. Thank you, Donna. Yeah, the investor entrepreneur's journey has just gotten much more difficult. And you've scaled Dawson Partners from 0 to 1. What are some of your most salient advice for an investor entrepreneur who sees a market opportunity and wants to build a firm to capture that opportunity today? And how do you see the pendulum shifting from kind of the very well-endowed incumbents versus new entrants? What are kind of the new right to wins for new entrants and things of this sort?
Let me start with the first one. So I always call it the 3 Ps: passion, persistence, and patience. That's what it needs to be successful. Patience is not my virtue, so I've been trying to work on that. But I think, look, if I were to kind of try and distill it down to 5 things, I would say 1, be ready to adapt and pivot. One of the things I'm probably proudest of is that, the way we started Dawson and where we're at today, you could never have imagined that this is what we became, and it's always about constant innovation and evolution, and just kind of getting feedback from the market about what's working and what not. And the place of like banging your head against the wall, usually if you step back, there's a door right here. And so that's one thing we're pretty proud of. I think number 2 is, I always say embrace change, don't resist it. And early in my career, I was not a part of that mantra, but over time, what I found is, I talk about this a lot at Dawson, is that there's a change train that barrels through our firm every day, and you've got a choice. You can get in front of it, it's gonna hurt. You can watch it go by, that's a missed opportunity, or you can get on the change train. And so if you see the positive in change, if you're a person that is, oh, wasn't it nice when, then I think that there's a lot of opportunities that can be missed out at the place of looking forward and embracing that change. Probably number 3 is people. People talk a lot about people. It's our only assets at the end of the day. So our objective is to provide a safe place for people to grow, both personally and professionally. Humans don't like change. A lot of what we're talking about here is change. Humans don't like uncertainty. You got to create a safe place for people to feel like they're, that you unleash their full potential. There's a lot of self-limiting beliefs in human beings, and there's a difference between confidence and conviction and arrogance, but there is an ability for people to do so much more than they can. So if we can provide that safe place, I think what I'm proudest of is watching some of our early joiners become who they are and the success that they've had. Culture, I mean, people talk about culture. We're a growing firm. You need to nurture that culture. I think we do so by focusing our performance reviews to have that cultural element on it. So it's not just what you do, it's how you do it that gives us great pride. And how we measure that is that on the what side, so you're marked out of 5 at Dawson. On the what side, you can be not good 1, good 2, great 3. The how is you're culturally inconsistent 0, culturally consistent 1, culture carrier 2. So you need to be a 4 and above to proceed. So you can be great at what you do, culturally consistent, or you can be culture carrier and good at what you do. You move forward. But if you are great at what you do and culturally inconsistent, or if you're a culture carrier but not good at what you do, you don't move forward. And that's how we measure culture at the end of the day. Like, do you live and breathe Dawson? Do you put the firm ahead of your personal agendas? Do you make sure that at the end of the day, you're doing it for the right reasons? And that's something that we monitor very closely to maintain that culture as we grow. And I think probably the last point is you can be a good person and win. I grew up at the Canada Pension Plan Investment Board. I was there for about 15 years. And one of the things that you learned is, you talked a lot about this, right process, right structure, right mindset, in it for the long term. Don't make short-term decisions. You can be a good person and win. And actually, when you're a good person, what happens is that people enjoy working with you. And so when that happens, then all of a sudden they want to work with you more and you get repeat business. So we want to be able to look at ourselves in the mirror. I want to be able to look at myself in the mirror and be able to be proud of not just what we have done, but how we have done it. And that's something that's very focused on us. So that's the journey. That's been the journey. Look, new entrants, incumbents, I'll be a bit quicker on that one. I just think, look, private markets is growing leaps and bounds. There is space for all participants in this. I look at the secondary market. It is vastly undercapitalized. $500 billion has been deployed in the secondary market. $325 billion has been raised since 2021. Okay? It is an undercapitalized market. There's huge opportunities. So we actually welcome new entrants to this market because it helps capitalize it. This is a raise and deploy market. We are constrained in the secondary market by the capitalization of this market. The more we raise, the more there's more opportunity out there. So I think that from our perspective, what we only ask of new entrants is right process, right structure, right mindset, some of the things that you were talking about, NAV lending, continuation vehicles, all of that. Think about all the stakeholders and make sure you can find a win-win-win. But you need to approach it with that mindset. And secondaries, continuation vehicles is very different than direct investing. There are more stakeholders that you need to take care of along the way. It's very nuanced, and you have to have the right mindset.
Great. Thank you, Ian.
Yes.
Miranda, lots going on in this world today. What is the most underappreciated and not talked about risk in your mind and opportunity?
Yeah. So first of all, I'll start with the risk.
Yeah.
I think the biggest risk in private markets is the increasing misalignment between GPs and LPs. Many GPs like to build their platforms, consolidating strategies, launching adjacent strategies. We see crowds in capital chasing for the same opportunities. LPs look for long-term performance, long-term partnership. So the risk is the risk there. LP got to ask question to ourselves is, are we backing platform builders? Are we backing investment managers managing our investments? That's the biggest risk. Opportunities, I'm super excited about private markets. Number one, I think the technology, AI, is gonna solve lots of issues we have today. If I think about the private markets data, there's so much tremendous data available in the portfolio company you looked at, the company you lend to, the GPs. If all this data are used in an innovative way with AI, potentially there will be a private exchange available. There's more transparency, there's more valuation available, and GPs just focus on value creation. The second one, it's like from personal experience, like sitting in the Middle East, I don't always know the best lower mid-market or mid-market managers in US, in Asia, in Europe. So that's been hidden gems. So there's an opportunity for somebody like yourselves with established platform to create a vehicle for international investors to participate in those managers that stick to the core of private equity, the value creation, building business, win-win situation. I think those would be a fantastic opportunity as an international LP.
Yeah.
Can I push on that a little bit?
Yeah.
Because one thing I've learned in 25 years is complacency kills and evolution enables. And so it's really interesting when GPs evolve. The question is why, right? And is it for the right reasons, right? Because I think that the danger in not evolving, not innovating, not growing, I think about Dawson and say, like, if you're not growing, this is the firm. There's nowhere to go. If you're growing and evolving, then there's different opportunities. The people you can attract, retain into it. And by the way, if you're not evolving with the market, you're going to be left behind. So that I think is, as an allocator at CPPIB, one of the things that I got probably a little bit wrong is I would think of change as strategy drift, right? And that was seen as negative. But actually, if you're not constantly evolving, you're going to be left behind. And that's another danger that I'd be focused on as an LP.
Yeah, totally agree. I like GPs that innovate because of opportunity, because market is never the same. The solution the market needs are different. I guess the key is always about alignment. What's your ultimate goal? Is that creating alpha, outperformance, or is that purely management fee driven?
Correct. I agree.
Yeah, and maybe just a couple. Well, actually, I'll go over to Bennett on this question as well. Alignment always sounds really great in a pitch deck. But in reality, do these kind of new fund structures, GP solutions, continuation vehicles actually align incentives, or at its worst, do they catalyze misalignment?
Yeah, so let's we'll focus on one of them, continuation vehicles.
Yes.
Is flavor of the day, and I do agree with Jacob that it's going to continue to grow.
Yeah.
I'll give you the negative case, where the misalignment the perception of misalignment mostly resides. If you're an LP and you want the best possible price for a portfolio company, you want the GP to hire Goldman Sachs, Morgan Stanley, create an auction, get the competitive juices flowing, find somebody that's inhaled those animal spirits and grossly overpays. Then you know you got the best price. In continuation vehicles, you don't have that dynamic.
Yep.
On the other hand, you get a very fair price, and you can address some of the alignments, and we've seen in the industry, continuation vehicles 2.0, 3.0, where one, there has to be a rational case for why Jacob and Platinum Equity on this particular asset has not completed their enterprise value creation opportunities. It is not the right time to sell. On the other hand, they've held it for 4 or 5 years. So, I think that's one criteria. Another criteria, the GP's rolling 100% of their carry and not cashing out.
Yep.
Third criteria, they're putting up new cash to justify the price. And I think that at the end of the day, the LP in these continuation vehicles, they still have the option to either roll or cash out. Now, a lot of LPs don't want to make a decision. They want the GP to make the decision for them, and that's where the noise is. But I think when you cut through the noise,
Sure.
the alignment's getting better and better. Now, it didn't start that way. Very few innovations in our industry start with great alignment. Usually the GP has all the leverage and they jam something down the throats of the LP, or the LP has all the leverage and they do the same. But I think it's getting to a pretty good place.
Got it. Thank you. I just one comment on that, though. I do think 15 years ago, life was a lot more simple, right? There was a time when you had, kind of fund 1, fund 2, fund 3. You had a GP commit there, and LPs could sleep at night understanding that the GP just really cared about the outcomes of the 36 companies that were held in those funds, and so you could sleep well at night. The business of investing is already so complex, right, that you just keep everything else very simple, right? I do think there are, the most extreme situations today. If you had 2 GPs, one just had 2 funds, their GP commits, great alignment. Another GP had 2 funds, but 2 continuation vehicles that represented 60% of their net worth. As an LP, and you're not participating in those 2 continuation vehicles, there could be a perception, you are going to spend your time where your net worth compounds, right? And so I think it's just, and again, as an LP, I welcome innovation into the ecosystem, but I think the job is just now, LPs need to be more diligent, right? Just around the alignment piece. It's just become a little bit more complex.
Anytime there's change in an industry, it's uncomfortable, and you need to navigate it. And at times there's friction in terms of as people try to figure out what's the best way of going about doing this. And you can find examples, on the extreme of things that didn't work because, as we said before, it's not perfect at the end of the day. But encouraging versus stifling innovation with the right process, right mindset, right structure, so that you can have more liquidity options and provide the option but not the obligation for liquidity, whatever form that is, continuation vehicle, other ways, I just think is beneficial to the industry and certainly over time.
Sure.
On average.
Yep. Jacob, Platinum Equity is probably one of the best in the world at targeting complex situations and companies navigating great complexity. But it seems today, some PE firms are becoming highly complex themselves. Is this evolution healthy, or are we turning investment firms into operationally complex behemoths that dilute focus and alpha generation?
So I too believe in evolution as a firm grows.
Yeah.
But I think the greatest manifestation of the question you're asking is these public asset managers that have grown and become very diverse, very large AUM, but also public.
Yep.
And there is often a group of investors, being public investors, who are very invested in the management fee side of the business.
Yep.
And then LPs who are actually invested in the carry side of the business, because if carry is being generated, the LPs are making money.
Correct.
And there's a disconnect. And you have to be thinking very carefully around, am I investing in, and Miranda made this point, an asset manager or an investor? And those are different philosophies and different mindsets about, do I want to just gather assets and scale, or do I want to really focus on value creation in the investments I'm making? And you know, at Platinum, we've been just deeply focused always on the investor mindset. We manifest that in terms of where we actually put our money where our mouth is in that regard. We've been 12 cents as a group of executives at Platinum, 12 cents of every dollar invested over the life of our funds. We are our biggest owned single LP as a group. And I think it's very important to be evaluating that and thinking about that. So yes, we are creating operationally complex businesses over time as things evolve, but if the alignment stays correct, that's okay.
Yeah. I think those those days are, I think as a GP, you thought of yourself as a private equity partner, really your asset management firms. And I think like Bennett and I are in this business of GP solutions at the end of the day. We're going to see a lot of consolidation in private markets. Some of it will be good, some of it will fail, but that's the next chapter. And so eyes wide open on alignment.
Donna, last question before we move into lightning rounds here. It's going to be fun. What are the most exciting financial technology problems that you're seeing founders and internal teams try to solve today? And are there any that might really move the needle for our ecosystem?
Yeah, so I think all the solutions that would move the needle are really around data. And normalization, standardization of data. I talked about a lot of the challenges to democratization, if you will, but it's not just about democratization, it's just dealing with this enormous growth. And I'd say, you could even say as a second order, this conflict between kind of fee-based, management fee-based, what we were just talking about here, versus kind of alignment between the GP and the LPs. So I think that there's a ton of innovation happening there. We've been talking, everybody talks about AI. Large language models have been around for a long time. I know at State Street we've been doing this work for over 10 years with large language models before we started calling it artificial intelligence. And how do you kind of digitize all of that data up front and then normalize it and create really modern ways to interrogate that data, make it available to both investors as well as people who are doing the boring admin stuff. So I think that's this thing. I mean, there's a ton of innovation happening everywhere, both internally driven as well as I said, the Fintech space. I'd say the second area is on distribution. So you go from club deals of 100 LPs to potentially thousands of investors. Can't do it the way we're doing it today. It just won't work. So there's a lot of innovation happening there. And lastly, I'd say, and this is specific to State Street, so I'm kind of talking my own book, especially on the asset owner side, they really want to see their public portfolio with their private portfolio side by side so they can do performance, risk analytics, et cetera. There's very few firms that are doing that. We're doing that, bringing that all together in kind of an OMS type on the desktop for the portfolio manager.
Very useful from my seat. All right, we're going to now embark on some final lightning round questions. These should be kind of fun. Again, less than 5 seconds. We have 2 minutes left. What would you want to eat for your last meal?
In Canada, we have Miss Vicky's, and they got spicy dill pickle chips.
Nice.
Anything involving chocolate.
Ooh.
Chinese hot pot ending with the dark chocolate.
Oh.
There you go.
It's the last meal means no consequences. How can you build a ribeye steak and mashed potatoes?
I go with Lebanese food.
Nice.
Awesome. Favorite place to travel?
London. Want to be knighted.
Japan, still maintaining such a distinctive culture. It's just a really interesting place to go.
Seychelles, not a resort, island hopping and hiking together in one place.
Oh.
Spain, culture, food, etc. Sun.
Beautiful.
Canadian Arctic, the last frontier.
Nice. Favorite hobby outside of work?
Canoeing in the Arctic.
Tennis.
Cooking.
One of my superpowers is I have no hobbies. Work is my hobby.
Private
Work is
equity.
my hobby. I love
That's
it.
very sad.
That's what I love. Yep.
This is why he's a private markets titan, everyone.
Golf.
Golf, awesome. What do you know now that you wish you knew 20 years earlier?
I wish I was more technologically proficient. I'm a dinosaur. I think I'm about to join LinkedIn finally.
You might get flooded. I would say on the few deals that have not worked exactly as planned,
Yep.
like just wishing had those lessons ahead of time and had the insights on how to have thought about them differently going in.
Got it.
Yeah. Perfection is a moving target. Most of the time, nobody cares. Just focus on your own path.
I have no answer to that.
Accelerate the process of inner stillness and build self-love.
Oh,
Nice.
that's deep.
That was a really good
Last
answer.
question. For what in life are you most grateful?
My turn?
Yeah.
Oh, I got life itself. I mean, it's we're here for a short term. Make the most of it.
Children, my kids.
Yeah, family and kids.
Opportunity to work with my colleagues at Platinum, my family, and having lived in America where I still think it's the greatest country in terms of being able to achieve your dreams and having opportunity.
Awesome.
Next week is my 40th anniversary to that very attractive woman in the third row.
Oh. All right, well, to our panelists, thank you for your candor, your clarity, your creativity. And to the audience, may your diligence be deep, your pacing plans realistic, and your side letters short. Thank you all.
Thank you.